Welcome to the second episode of Tax Break, a podcast about the tax law brought to you by Miller and Chevalier. Before we begin, we have a confession to make to our listeners. Our first episode, which we hope you've listened to already because it features our colleague Jorge Castro and discusses some of the CARES Act business relief provisions, was actually the second episode that we recorded.
Well, if we're getting technical, it was really our third episode because our first attempt ran long. We're trying to keep these down around 20 to 30 minutes, and we decided to divide it in two. So you're about to listen to episode 2, but as you'll hear, we introduce it as our first episode. We recorded it before the lockdown, so you'll have to forgive us. In any event, here's our second episode. We discuss the December 2019 BEAT regulations.
Welcome to the first episode of Tax Break, a new podcast on the tax law brought to you by Miller and Chevalier. I'm Steve Dixon. I'm a tax lawyer at Miller and Chevalier, and I do tax litigation, and I'm joined by my colleague, international tax and tax policy expert Loren. The idea behind Tax Break is to provide listeners with some perspectives on select tax issues that we think are interesting. We want to go deeper than what's in the tax press, but stay sufficiently high level so you can follow along without a copy of the regs in front of you. As always, first, a disclaimer. Tax Break is not intended to be legal advice, and you cannot rely on it as legal advice. Its content reflects only the thoughts and opinions of its hosts or guests. So for our first podcast, we wanted to kick things off with a semi-timely topic, which is the release of the final and proposed regulations under Section 59A, the BEAT, from December of last year. And true to our commitment on Tax Break, we're not going to stuff you with detail about either set of regulations. Instead, we wanted to select a couple of the issues that we thought were interesting in the regs and discuss those. So for today, the first issue involves determining whether or not there's a base erosion payment for BEAT purposes. The final regs effectively punt on that question, deferring to general tax principles and general legal principles as a way to decide whether or not there's actually a payment. We're going to discuss the upshot of that regulatory choice. The second issue we'll talk about involves how the proposed regs deal with the waiver of deductions in the BEAT context, which, for my dollar, raises some interesting questions about some tax issues that are, for lack of a better term, foundational. So let's start, and Loren, I want you to kick it off if you can, and let's talk about the general tax principles issue and how did that bubble up?
Sure.
In the BEAT context.
Yes, this is going to be a good discussion, I think. So if we look back to, let's say, January 2018, right after the BEAT was enacted, a lot of taxpayers started to discover the nuances of the rules and figured out that there were some pretty harsh effects, especially with respect to related party services. And so a major complaint was that the 59 Cap A rules didn't really take into account transactional flows that were in place prior to TCJA's enactment, whereby the net effect of inbound and outbound related party payments resulted in income actually coming into the U.S. tax base. And so the idea that you would have an anti-base erosion rule that kicks in when you're not actually base eroding on the global scale was confounding to many, to say the least. And so if we're thinking about just why the BEAT exists in general, and we look at the legislative history of the rule, we have a pronouncement in the Senate Budget Committee report that specifically calls out management fees, so service fees, between related parties and also related party interest as sources of outbound payments that the Finance Committee found to be kind of just indicia of base erosion without more. So there's no
sort of really presumptively problematic, if you will.
Right, presumptively problematic. They became de jure indicia of base erosion once the rule passed, but there was no analysis or really regard given to whether or not those payments were arm's length. That's an analysis that's reserved for 482 purposes. Doesn't matter if your payment is arm's length or not. So we're in this world where as soon as you have an outbound payment of a certain type, you're in the 59 Cap A space. So that's the landscape of what was going on. leading up to the issuance of proposed regs. So if we fast forward to the issuance of the proposed regs in December of 2018, Treasury knew that these comments were out there floating around and that taxpayers had certain positions about transaction flows that had been long established that shouldn't be necessarily considered to be base erosion payments. And so in the proposed regs, the Treasury Department did address some specific issues, notably the services cost method exception. We have the TLAC exception for foreign parented banks, and it also specifically addressed netting.
So it's kind of like a prospective notice and comment. They already knew that these comments were out there in the ether,
right,
and tried to address them when they proposed regs
right.
in 2018.
Trying to kind of offer some relief in the case of SCM and TLAC, and then clarifying that netting, in fact, is not a concept that has any room in 59 Cap A, which is a gross basis tax. So what they did not do is address these comments related to transaction flows and the myriad ways in which taxpayers remunerate related parties for myriad services or goods, what have you. And so they, instead of having any kind of specific rule for a common fact pattern, which of course would leave out other taxpayers that don't have that fact pattern, Treasury just said, you know what, we're going to rely on general tax law principles. We're not going to give a bunch of rules for what qualifies as a base erosion payment. We have this 4-pronged test. Look at the test. To clarify whether or not you fall into one of the 4 situations, look at general tax principles. And they specifically noted agency, reimbursement doctrine, assignment of income principle, and case law conduit principles in the preamble to the proposed regs. And so, again, taxpayers didn't feel like their comments had been addressed, and now they did have the opportunity to comment. So between proposed and final, all kinds of letters were sent in with specific examples. And
so did taxpayers actually prove the case that Treasury made at the outset? That so Treasury says there are too many possible permutations for us to cover in the rules. The rules would become too complex and unadministrable. So we're going to rely on background legal principles, and then taxpayers come in and say, well, wait, look at all of these different factors that you're running over. And that sort of proves Treasury's point at the outset.
Exactly. I don't think it's unreasonable. Having been on the side of trying to draft rules, it's impossible to anticipate every single fact pattern. And the best you can do is offer clear rules, clear guidance, and hope that taxpayers are able to use that guidance and apply it to their specific fact pattern. But it's impossible to anticipate all the situations that people are actually experiencing. And so, again, they kind of broke the comments down into 3 groups of typical fact patterns that taxpayers raised. One was middleman or pass-through payments. The second one has to do with global revenue sharing. And then the third was the issue that won't die, netting, what to do when at the end of the day you actually have income coming into the U.S., not going out, even though you have base erosion payments as defined in the statute. And
so all instances of money changing hands across foreign affiliates and U.S. and their U.S. parent or U.S. affiliate, and where there's arguably not something that you would call a payment that ought to be captured in computing your beat liability.
Right, because or
eligibility for the beat, I guess.
Right. Your whether or not you get to that threshold, right? The all important 3% or 2% threshold. But they are clear that a base erosion payment is defined in the statute, and whether or not, and we'll get to the actual language that they put in the final regs, but whether or not you actually have a payment that constitutes a base erosion payment is, once again, made under general tax law principles. And they went a step further and actually put that language in the regulations, so it's not just in the preamble, which gives a little bit more credence to the idea, a little bit more weight. And so the specific language that they did adopt that is in the final regulations is under 1.59 Cap A -3B2 Romanet 1. and it says that the amount paid or accrued and the identity of the payor and recipient of any amount paid or accrued is made under general U.S. federal income tax law, period. So there's your codification of sorts of the rule.
Of the case law that is already itself law. Right.
Yes, but it's just out there. It's more than preamble language. It's actually in the regs. And they also went a step further and clarified in the preamble that netting, and this is also in the actual text of the regulations, netting there's no room for netting, despite what your contractual agreements might call for, or what, at the end of the day, the law calls for. You may net things for other purposes, but in terms of defining a base erosion payment, there is no netting. And the exception is mark-to-market transactions.
So you mentioned earlier that the BEAT is a gross basis tax.
Right.
And that seems to me sort of fundamentally connected to them expressly disallowing netting as a principle. Could you elaborate on that?
Yes. So it is a gross basis tax. It's modeled after AMT, which is also gross basis tax. And then you have reductions for preference items. And so that architecture is replicated in 59 Cap A. The only calculus you need to make is the quantum of your outbound deductible payment, and whether or not something else is coming in to offset that payment, even if they're related to the same general transaction, is irrelevant. And that's just the way the statute is written. There's not, even if Treasury wanted to, I don't think there's any room in the statute to allow for netting beyond what they have.
Meaning there was nothing in the statute that Congress sort of expressly delegated to Treasury or implicitly delegated to Treasury in terms of netting payments against each other,
right,
in the BEAT context.
So one might take exception to that conclusion when you think about the services cost method exception, which does kind of tease out your cost basis, and then it only treats the markup component as a base erosion payment. And I understand the logic behind that, but truly in a gross basis tax scenario, that demarcation or delineation may not make that much sense. We don't care about what the cost is. We just care about the outbound payment. So there's a little bit of a mismatch.
So that it's sort of an equivocation, if you will, that on the one hand, we're applying this on a gross basis and we refuse to do netting, but in certain circumstances, because of presumably industry pressure and the like, that they're willing to allow it in cases where presumably it's easy to measure as well.
Right. And there is the actual statutory language that has the SCM exception, which gives, a lot of room for the clarification that was in the proposed regs and got imported into the final regs. And I agree that it makes sense. I wouldn't take a position otherwise, just from a transfer pricing perspective and understanding what that exception means. But if you want to be a purist of sorts in 59 Cap A context, it is a bit of an anomaly.
It's possible that Congress wasn't completely rigorous in applying it, in applying this gross basis, gross income tax.
There is the SCM exception in the statute.
True.
And we have to live with it. So there we go. So that's the backdrop against which we are operating today, right? So we have the final regs. We have this reliance on general tax principles to perhaps, I don't think I'm telling tales out of school here, perhaps get us out of having base erosion payments. So what are these general tax principles and how might we apply them in some common transactions, right? And so if we look back, we already talked about why this makes sense, right? So we don't want to have myriad rules. We don't want to pick winners and losers. And in tax policy, those are things that you kind of try to stay away from. And so Treasury, I think, in a very reasonable fashion, said these are the rules that we can realistically and legally establish given our regulatory authority in the statute. And here's where we have to draw the line. And we're going to draw the line at these special circumstances and different fact patterns, and basically put it back on taxpayers to figure it out. And so even though they mentioned a few in the proposed regs, those are a little bit different than the ones we're going to talk about today. So we're going to go through agency, the trust doctrine, reimbursement doctrine, and conduit principles that have arisen through case law. And I'm just going to run through each of those four really quickly to give our dear listeners a little bit of an idea about what each of them is.
And the irony of all four of these is that these are traditionally doctrines that the IRS has invoked in trying to essentially ignore certain cash flows in order to capture more tax
revenue. Yes.
revenue. And so the irony is that now taxpayers may be relying on those same principles to essentially disqualify certain cash transfers as payments under the beat.
Right. Before, taxpayers were kind of in a position of wielding their shield against the IRS enforcing these principles.
Their form shield.
Their form shield, and now they have the sword, and they can hopefully get out of being characterized as having engaged in some base erosion payments. So first we have agency, and I'm going to quote here from National Carbine Corp., which generally this case stands for the proposition that when an agent collects or pays amounts on behalf of a principal, the tax consequences of the transaction flow to the principal, not the agent. The next one we have is the reimbursement doctrine. And this, I'm quoting from Glendenning, McLeish and Company v. Commissioner. And under the reimbursement doctrine, simply a taxpayer is not entitled to a deduction for a reimbursed expense, and the reimbursement is not included in gross income. The trust doctrine says, and this is from 7UP, which is a famous, semi-famous tax case. I would say it's famous.
I would say it's famous.
I think so. The advancement of funds to an intermediary entity may be excluded from the intermediary's gross income if control and discretion over the use of the advanced funds is sufficiently limited and the intermediary does not derive profit from the activity. Finally, we have good old conduit. And I'm quoting here.
Swiss Army knife
of
doctrines.
Exactly. It can be used in a variety of situations. And I'm quoting from Aiken Industries v. Commissioner. And the conduit doctrine generally stands for the proposition that the recipient of a payment does not realize income if it is a mere conduit for the funds and does not take beneficial ownership of the funds. And
so the trust doctrine and the conduit doctrine are
kissing cousins.
Yeah, a little hard to distinguish.
Yes, they are kissing cousins. And I think if you look at the facts of 7UP and kind of the context of why they were taking these amounts from their subsidiary, or actually bottlers from around the country, 7UP, the headquarters, took the amounts and then used them for a national advertising campaign. So I think of trust doctrine almost in the context of services as something that's happening at the headquarters for the benefit of the entire group. Now, I'm sure it can be more broad than that, but it kind of helps distinguish from simply a conduit situation, which I think of as almost in the reverse, kind of a payment going down and then going out. But of course, it doesn't have to be in that direction.
And theoretically, there's probably a timing distinction that under the trust doctrine, if the funds are sort of collected and held for some period of time, in the conduit, it's less of a delay.
Exactly. And we'll get into kind of distinguishing facts that might make one principle more attractive to rely upon than others, given the fact pattern and the situation that taxpayers find themselves in. So let's return to those three situations that the final regs identified in the preamble. So we have middleman or pass-through payments, and then we have revenue sharing agreements or scenarios, and then we have netting. So we're going to go through each of those and look at which of these general tax principles might be used to mitigate the impact for 59 Cap A purposes.
All right. So Loren, you have some examples here that will help us understand these different general tax principles. And on the middleman or pass-through payment, we can imagine, and I think this is a pretty typical scenario, if you can imagine a U.S. parent that is funding research outside of the U.S., and it pays, let's say, $150 to its CFC, who in turn pays a third-party contract R&D provider. that is the case where that money, that $150, is going effectively from the U.S. parent to a third-party contract R&D provider, but it goes through the CFC. So how is that treated for BEAT, and how can general tax principles influence how we treat that for BEAT purposes?
Right. So in 59 Cap A analysis, that would clearly be a base erosion payment, right? The U.S. parent is making $150 deductible payment to its CFC, and the analysis stops there. We don't go all the way down to the end of the supply chain. But if we look at what's actually happening, I think several of the general tax principles might apply depending on the facts. So, of course, we have agency. It depends on what the CFC is. Is it a dependent agent? Is it an independent agent? And if it qualifies as an agent, a dependent agent, it doesn't really have any kind of control over that money and it's just paying on behalf of the parent, then we would attribute that payment to the parent, to the principal in that agency relationship.
This is not a unique scenario, right? I mean, you can imagine a case where the parent actually wants to reflect the payment to the R&D provider on the books of the CFC. This is not it's not as if this is an unnatural structure in any way.
No, not at all. I don't think so. And I think that was the point that many taxpayers were making, that these are long-standing transaction flows that actually have a business purpose that are all of a sudden problematic from a 59 Cap A perspective. But, in 2017, this would not have really raised any red flags or any years prior.
Of course.
And so if we could also look at this through the lens of conduit and say, all right, maybe, we can just look at the CFC as a pass-through, and all they're doing is acting as a vessel through which this $150 flows from the parent to this third-party service provider. And I think here, some of the timing issues you mentioned earlier are really important. If you're going to have a conduit payment, what is the CFC actually doing with this $150? Are they turning around and paying it the same day they receive it from the parent? Are they holding on to it for a little while? Conversely, we could look at it from a reimbursement doctrine. What if the CFC paid the $150 to the third party itself first and then just gets paid back from the U.S. parent? It's a little bit of a different scenario. They're using their own money, so to speak. But it just depends on the facts.
It's also possible that the 150 is part of a whole bunch of different intercompany payments, some of which are inbound and some of which are outbound.
That's right.
And only the outbound ones are counting against you under the BEAT context.
Yes, when you are the U.S. entity.
And you can imagine a scenario where your intercompany accounting becomes an issue, so that you can say, for BEAT purposes, no, we're going to treat this as a conduit. It passes through the CFC, but
you still have to book it as
right.
having left the U.S. and gone to the CFC.
And it hits the CFC's books. And so the government has on its side the way that you treated it presumably for financial accounting purposes.
Yes. So let's next turn to revenue sharing arrangements. Are you going to set this one up for me?
So this is another instance of the kind of transaction that would be very unsurprising to see in nature. So suppose that you have some customers, some of whom are inside the U.S., some of whom are outside the U.S., and they're receiving services from both the U.S. company and from its foreign affiliate. And instead of paying each of those different companies, the customers make a single payment to the U.S. company, who in turn takes the sort of allocated portion of the revenue and passes it then along to the CFC. All it's doing is paying the CFC the share of its revenue that it earned, and presumably it's probably the arm's length share of the revenue that it earned. But how is that payment treated under BEAT?
Under BEAT, that is a base erosion payment. And so you'd have to look at really what's happening here. And the U.S. is not holding on to this money for itself. It's just on paying the CFC its portion for provision of services. So once again, we could look at conduit and say, all right, well, there's no beneficial ownership. It's a flow-through payment. That's it. And so we're not going to treat it as a base erosion payment for 59 Cap A purposes. So I do think it's interesting that Treasury took care to note in the preamble to the final regs that all these comments received with respect to revenue sharing agreements, arrangements, particularly profit splits, writ large. Profit split is a method. It's a transfer pricing method. And taxpayers have to be careful not to conflate a method with evidence of a payment not being a base erosion payment. It's not dispositive. So just because you're engaged in a profit split doesn't mean necessarily you don't have a base erosion payment. You're going to have to do the work and do the analysis to get there.
So we're gonna allow you to do a profit split, but we're not going to allow you to opt your way out of particular beat payments by virtue of your 482 method.
Right. Just because you're engaged in a profit split, that alone is not sufficient.
And I think the last one we have is this sort of the idea of what netting might look like. So assume you have, and again, this is another thing that is not exceptional in nature. So suppose that you have the U.S. company funding a portion of the marketing expense of a CFC. So if you imagine the U.S. company sending $150 to its CFC, the CFC then in turn is spending that on third-party media, but the CFC is also paying a royalty back to the U.S., suppose $200. So you have this $50 effectively net U.S. income, but that $150 marketing fee, how is that treated for beat purposes, and how would you argue for netting in this context?
Right. So we have, as you said, a net $50 inflow into the U.S. We have $150 going out, and we also have a $10 markup that remained at the CFC level. So I think we could look at this two ways. We have an outbound $150 payment. Maybe we could use services cost method to analyze that amount and say, you know what, the $140 is really just cost of the CFC. Look, they pay this third party. The markup is $10, and that's what your base erosion payment is. That's separate and apart from general tax principles. But I think you would get to the same answer. You could argue that the CFC was only holding the $140 as a conduit. The U.S. was using the CFC to pay that on through, and they keep a $10 payment. And so you have a $10 base erosion payment. You could also argue that, you could change your payment flow and just have CFC pay a $50 royalty and retain that $150 at the CFC level instead of turning around and paying it right back up, essentially is what's happening. But then I think you might run into some transfer pricing issues. Perhaps, is that $50 an arm's length amount for the royalty? And if it's not, was $150?
Right.
You have a disconnect. Either it was arm's length before and it's not now, or it wasn't before and it is now.
Now it is.
So you're going to have to get a narrative together, if you will, about why that 50 now makes sense from an arm's length standpoint.
But it also implies a kind of perverse incentive for taxpayers. I mean, in this circumstance that we described, you have presumably the reason why you have a $200 royalty coming back into the U.S. is because the valuable IP that both the parties are investing in is owned here in the U.S. This seems to suggest that it would be better if you owned this outside of the U.S.
Steve. Well, it's true that TCJA really did have a stated intention of having taxpayers move valuable IP back to the U.S., having jobs, sophisticated functions be located in the U.S. And so, query whether or not that policy aim is being satisfied, where you have a perverse incentive to kind of net your payments yourself and undervalue, or not undervalue, but at least have IP that is only going to support a $50 royalty as opposed to a $200 royalty.
Right. And let's talk last about netting of income in the cost sharing context. Mm-hmm. So if you assume that you have a cost sharing arrangement, right? So typical cost sharing arrangement, and suppose you have the U.S. company and one foreign CFC, both of whom are incurring intangible development costs, or IDCs, as the transfer pricing
As the parlance goes.
Yes, in the parlance of our times.
Yes.
So suppose the U.S. is incurring 280 and the CFC is incurring 140. Then you have the resulting revenues from those, right? And so how do you treat the fact that some of those revenues might be coming into the CFC and then passed back to the U.S. company in that circumstance?
So here's the good news of today. Netting is permitted in a cost-sharing arrangement context. So we can go back to the regs, the final BEAT regs, which say generally netting is not allowed, but for instances where it is allowed in other provisions of the code or regulations. So there's an example in the 482 regulations, 482-7, highlighting you kind of net your PCTs, your platform contribution transaction payments, and your IDCs to get to whatever that final amount is, and you pay it in or out. And in the example that we are going through, we're assuming that the net is an income flow into the U.S. And so in that instance, even though there are some outbound payments to the foreign cost-sharing participant, we are not going to treat those as base erosion payments.
So the stakes are even higher to do a cost sharing. Not only does it eliminate the uncertainty about the correct arm's length pricing, but it also permits you to net in a way that might be favorable for BEAT purposes.
It does, but cost sharing arrangements are not easy things to plan into. So I'm not sure, even though they do offer significant relief, I'm not sure that they're a planning tool so much as a beneficial result if you happen to already be in one.
So that brings us to the end of the second episode of Tax Break. We hope you found the discussion interesting, and we invite you to tune in to our next episode where we will return to our discussion of the December 2019 final BEAT regulations. In the meantime, if you have any questions, comments, or suggestions for a topic you would like for us to address, please email us at podcasts@milchev.com. We look forward to hearing from you. Until next time, please subscribe and listen.